Okay, so let's unpack this. Today, we're taking a deep dive.
Into blockchain's history,
Yeah.
especially Bitcoin.
Exactly, the foundational history and that whole groundbreaking story of Bitcoin. Our journey, well, it'll trace the very first sparks of digital payments.
Right.
Through the revolutionary ideas that birthed Bitcoin, right into how it actually works under the hood.
And then we'll even compare its core mechanism to newer stuff like Ethereum.
Yeah, and we'll round that out by exploring Bitcoin's journey, in the real world.
Its ecosystem, which is huge now.
Huge. And the criticisms it faces, what its future might hold.
Including some pretty surprising philosophical takes and the whole regulatory side of things.
Our mission for you today is basically to give you a shortcut, a shortcut to being truly well-informed about this foundational technology.
Packed with, hopefully, some surprising facts and insights.
So what does this all mean for the future of digital value? Maybe even decentralized trust itself. Let's jump in.
Okay, so we actually start our story, maybe surprisingly, not with Bitcoin itself.
Right, but way earlier.
Way earlier. With the first sparks of digital transactions, did you know digital processing of payments kicked off way back in 1955?
In 1955, wow.
Yeah, Bank of America unveiled the ERMA computer. It was for check processing.
And that cut processing time by 80%.
Yeah.
I mean, that's a massive leap. Really foreshadows the whole drive for faster, more secure digital value.
It really does. Shows how long we've been on this quest.
Absolutely.
And that drive just kept going. So 1973, Visa digitizes credit cards, another efficiency boost.
Then you hit the 90s, the World Wide Web arrives.
And boom, 1994, Pizza Hut's accepting online orders.
Pizza Hut. Wild. Soon after that, the first online banks pop up, like OP Financial Group.
And by 97, Coca-Cola was doing mobile payments via text message.
It really sets the stage for how quickly this stuff scaled up.
Oh, completely. Today, electronic payments are, they're everywhere. 2/3 of all non-cash payments.
Think about it. You probably use tons of apps, right? For everything from buying coffee to sending money to friends.
It's easy to forget how much our financial lives have changed, really, in just a few decades.
But here's where it gets really interesting for Bitcoin. It didn't just appear out of nowhere, right? There was crucial groundwork laid years before.
Definitely. Even before the concept in 2008 and the launch in 2009, there was this really significant movement called the cypherpunks.
Ah, the cypherpunks. Activists using cryptography for social and political change.
Exactly. And their ideas are, deeply woven into Bitcoin's DNA. Eric Hughes's 1993 manifesto is a key example. He was all about privacy, especially in payments.
So for them, it wasn't just tech. It was philosophical. Freedom of speech, exchanging ideas. They felt that required privacy, even for your money.
Right. And they proposed ideas for digital cash. Many cypherpunks actually contributed to Bitcoin later on.
We saw those early tries like DigiCash and B-Money. They used cryptography, aimed for privacy, but they hit roadblocks, didn't they?
They did. They were important steps, for sure. But they struggled with true decentralization, and especially solving that double spending problem without needing a central boss.
What problem is that exactly?
Double spending. It's the risk in a digital system that someone could spend the same digital coin twice. If you can copy digital files, how do you stop someone copying and spending their money multiple times?
Ah, okay. That makes sense. So the early systems couldn't quite crack that in a decentralized way.
Not in a really robust way. No, they couldn't quite assemble all the pieces.
And then separate from these payment ideas, other technical pieces were falling into place too. Like Hashcash, Hal Finney, 1997.
Yeah, Hashcash. Originally an anti-spam thing, it made you do a small bit of computational work, solve a cryptographic puzzle to send an email.
Expensive for spammers sending millions, but basically nothing for a regular user.
Exactly. And that concept, that proof of work, became reusable, a key building block.
Right. And speaking of building blocks, Nick Szabo's BitGold in 2004.
Oh, BitGold. Incredible paper. It came before Bitcoin, but laid out essential ideas, proof of work, decentralization.
But it never actually got built.
Never implemented, no. Makes you wonder how close things were even then.
So, okay, with all these earlier attempts and ideas floating around, why was Bitcoin the breakthrough? What did it solve that the others couldn't quite manage?
Well, it brilliantly solved this fundamental problem in decentralized systems. You've probably heard of it, the Byzantine generals problem.
The generals trying to coordinate an attack.
That's the one. A group of generals surrounding a city. They have to attack together to win, but if they attack at different times, they lose.
And the catch is, they can't trust their messengers. Messages might be fake or changed.
Exactly. So how do they all agree on the truth of the attack time without a trusted central command? That's the core challenge.
And that's what Satoshi Nakamoto, whoever they are, figured out how to solve.
Precisely. Just an incredibly elegant solution. So October 31st, 2008, this paper drops. Bitcoin, a peer-to-peer electronic cash system authored by Satoshi Nakamoto, still a pseudonym.
Right. Could be one person, could be a group. Nobody knows for sure.
And this paper, it referenced earlier stuff like Hashcash and B-Money, but it introduced a digital cash system with, well, game-changing properties.
Like what specifically?
Truly peer-to-peer payments. No banks, no financial institutions needed.
Cutting out the middleman.
Completely. Plus, a solid way to solve that double spending problem in a decentralized network.
Okay.
A chain of transactions or blocks secured with that proof of work concept, and crucially, built-in incentives, mining rewards to keep the network secure.
So let's break that down. At its core, how should we think about Bitcoin? What is this ledger people talk about? How's it different from my bank's ledger?
That's a great question. It's fundamental. Bitcoin offers something pretty radical. It's a distributed, secure, and immutable ledger.
Immutable meaning?
Unchangeable. Exactly. And here's the key. Participants don't have to inherently trust each other for it to work. The ledger itself is just a list of transactions. Who sent what to whom?
Okay, so unlike my bank account, which shows a balance.
Right. There's no balance field on the Bitcoin blockchain itself. Your balance is just figured out by looking at all the transactions linked to your address right from the very beginning. Everything's public.
And it gets called blockchain because these transactions are grouped into blocks.
And each block is linked to the previous one using cryptography. These hashing mechanisms creates this growing, unalterable chain of records.
Okay, let's unpack some other key properties.
Yeah.
You mentioned immutability. Once a block's recorded, it can't be changed or deleted. What does that mean for a user, practically?
It means censorship resistance. Nobody can easily block your transaction or erase it later. And transparency, because all those transactions are permanently there for anyone to see and verify.
It's a public, unchangeable history. That's a big shift from traditional systems that are often quite opaque.
Huge shift. Then there's privacy. It offers some privacy, but we call it pseudo-anonymous.
Yeah.
Your transactions use these long cryptographic addresses, not your real name. So on the surface, it looks anonymous, but every single transaction is public, visible to anyone. And there are companies now, analytics firms, specializing in tracing the money. They can and do link Bitcoin addresses back to real-world identities or exchanges.
So not truly hidden. Your identity isn't directly on the chain, but it can potentially be linked. That's important. Okay, third property.
Verifiable. Transactions have to follow strict rules. Like, you can only send Bitcoin you actually have control over, proven by your cryptographic keys.
And who enforces these rules?
The network itself. Thousands of computers or nodes around the world constantly check that new transactions and blocks follow all the rules. They just reject anything invalid.
Got it. And finally, maybe the biggest one, decentralized.
Yes. No single point of failure. No central company like a Bitcoin Inc. controlling things or changing the rules on a whim.
The network is run by, well, who runs it?
Different participants. You have nodes that just relay transactions and blocks. And then you have the special miners who actually create the new blocks.
And changing the rules, the core protocol, requires consensus from the whole community, right? Developers, users, miners, node operators.
Exactly. We saw that play out with the big debate over Bitcoin's block size limit a few years back. It led to a fork, creating Bitcoin Cash.
Right, shows the power and the difficulty of that community governance.
Precisely. The rules are enforced by the collective, not a single boss. That distributed control is key to its resilience.
Okay, so miners create the new blocks. How does that actually happen in this decentralized system? This is where proof of work really kicks in, isn't it?
Correct. Proof of work is the engine. So picture that chain of blocks. Each block full of transactions, each linked to the one before it by its cryptographic hash.
Like a unique digital fingerprint for the block's data.
Exactly. Miners are the ones competing to add the next block to this chain.
And how do they earn that right? You mentioned a puzzle.
They have to solve a computationally hard cryptographic puzzle. Basically, they need to find a random number. It's called a nonce.
Nonce. Like number used once.
Pretty much, yeah. A throwaway number. They take the data for the new block they want to add, plus the hash of the previous block, add this nonce, and run it all through a specific cryptographic hash function, like SHA-256. And they're looking for a very specific kind of result. The output hash has to start with a certain number of zeros.
Why zeros?
It's just an arbitrary target that makes the puzzle hard to solve. Finding a hash with, say, 20 leading zeros is incredibly unlikely by chance.
So they just guess.
They guess billions, trillions of nonces per second. Brute force. Trying different nonces over and over until, bang, one of them produces a hash that meets the target.
Wow. And that target, the number of zeros required, that's the difficulty.
That's the difficulty. And here's the clever part. It's variable. The Bitcoin protocol automatically adjusts this difficulty roughly every 2 weeks.
Why adjust it?
To keep the average block creation time consistent, around 10 minutes. If lots of miners join the network and blocks start getting found too fast, say, every 5 minutes the protocol increases the difficulty, makes it harder to find the winning hash.
And if miners leave and it slows down?
It decreases the difficulty. It's this self-regulating mechanism to maintain that 10-minute rhythm, no matter how much computing power is on the network overall.
Okay, that's clever. But what happens if two miners find a valid nonce at almost the exact same time? You'd get two different valid blocks pointing back to the same previous block, right? A fork.
Exactly, a temporary fork. It happens. The network needs a way to resolve this and agree on one single chain.
How does it do that?
It uses the longest chain rule. Miners will always choose to build on whichever valid chain is currently the longest.
Why? What's the incentive?
Because their mining reward is only valid if it ends up on the main accepted chain. There's an economic incentive to work on the chain that's most likely to win, which is almost always the one that gets longer faster. So eventually one chain pulls ahead and the shorter orphan chain gets abandoned.
And this longest chain rule, that also helps prevent the double spending problem we talked about earlier.
Yes. If someone tries to be clever and send the same Bitcoin to two different people in two conflicting transactions, putting one on each side of a temporary fork,
only the transaction included in the block that ends up on the longest chain will ultimately be considered valid by the network. The other one gets discarded.
Precisely. That's why, especially for larger amounts, merchants or exchanges usually wait for a few block confirmations.
Meaning they wait for several more blocks to be added on top of the block containing your transaction.
Exactly. The deeper your transaction gets buried in the blockchain, the more computationally difficult, basically impossible it becomes to undo or reverse it by creating an even longer alternative chain.
Makes sense. So when a miner successfully solves the puzzle, their block gets added, they get the reward. What is the reward now?
Currently, it's 6.25 Bitcoin per block. Plus, they also get to collect all the transaction fees from the transactions they chose to include in their block.
Ah, transaction fees. So users can pay a fee to get their transaction processed faster.
Yes. There's often a queue of unconfirmed transactions waiting to get into a block. This is called the mempool. Miners typically prioritize transactions offering higher fees as it adds to their overall reward.
Okay, this whole proof-of-work system is fascinating, but it uses a ton of energy, right? That's a major criticism. Is it the only way to get consensus in a decentralized network?
Excellent question. And no, it's definitely not the only way anymore. The landscape has evolved. If we look at Ethereum, the second biggest blockchain.
They switched, didn't they, from proof-of-work?
They did, a massive undertaking called the merge. They transitioned entirely to proof-of-stake, or PoW.
Proof-of-stake. How is that fundamentally different from proof-of-work?
Well, instead of miners proving they've done computational work in proof-of-stake, validators prove they have skin in the game by locking up or staking their own cryptocurrency as collateral.
So it's about capital, not computation.
Exactly. On Ethereum, for example, you need to stake 32 ETH to become a validator. If you act honestly and follow the protocol rules, like proposing and validating blocks correctly, you earn rewards.
But if you act maliciously, try to cheat the system,
you get slashed, meaning the protocol automatically destroys some or all of your staked ETH. So there's a direct financial penalty for bad behavior.
That sounds like a lower barrier to entry than proof-of-work mining, which needs specialized hardware and lots of electricity.
It generally is. You don't need a huge server farm or expensive ASICs. You can even participate in PoS by pooling your funds with others in staking pools if you don't have the full 32 ETH yourself.
And the energy difference is huge, right?
Oh, massive. Proof of work is inherently energy intensive because miners are constantly churning through calculations. Proof of stake doesn't rely on that brute force computation. Ethereum's energy consumption reportedly dropped by something like 99.5% after moving to PoS.
Wow, 99.5%. That's incredible.
Sure.
But are there downsides to proof of stake? More complexity, maybe?
There are definitely trade-offs. PoS protocols tend to be more complex than proof of work. There are different ways attacks could happen, often involving groups of validators potentially colluding, which is a different kind of threat than in PoS.
So how does block creation work in POS? It's still a race.
No race. Instead, validators are typically chosen pseudo-randomly from the pool of stakers to propose the next block. Then other validators attest, essentially. They vote on whether that proposed block is valid.
So it's more about coordination and voting based on stake.
Right. And while proponents argue PoS can be just as or even more secure overall, securing it against different kinds of attacks, especially collusion or censorship by large staking entities, is arguably a more complex challenge than the raw physics of PoW. Different security models.
Okay, that comparison is really helpful. Let's switch gears back to Bitcoin specifically. We've got the tech, the concept. What about its journey in the real world? After the software release, the first block mined in Jan 2009, that famous pizza purchase.
Ah, yes, the pizzas. May 2010. Laszlo Hanyecz bought 2 Papa John's pizzas for 10,000 Bitcoin.
10,000 Bitcoin, which today is worth what?
An absolutely mind-boggling amount. Tens, maybe hundreds of millions of dollars, depending on the day. Like $93 million was one figure mentioned. A very, very expensive pair of pizzas in hindsight.
Must be painful to think about, but a crucial first step for commercial use. And soon after that, Satoshi vanished.
Yeah, also around 2010, handed over the reins essentially to Gavin Andreessen and other core developers and just disappeared. Still anonymous.
Which, as you said, many see as a strength now, reinforces that decentralized idea, no single leader.
Exactly. Unlike many other crypto projects with very public founders, Bitcoin's leaderlessness is part of its character.
So after the pizzas, how did adoption progress?
Slowly at first. The first Bitcoin exchange launched in March 2010. Price was fractions of a cent, like 0.0003. It did gain some early, maybe notorious adoption on dark web markets like Silk Road.
Right, which gave it a bit of a shady reputation early on before the FBI shut Silk Road down.
It did, but then we started seeing these massive price surges, the bull run.
Oh yeah, like 2013, over $1,000. 2017 racing up towards $20,000, and then 2021 hitting almost $70,000.
Followed, of course, by equally dramatic crashes, the bear markets or crypto winters. That price volatility is just a core feature of Bitcoin as an asset.
Definitely. And alongside the price roller coaster, this whole ecosystem sprung up.
A massive industry now. You've got the big centralized exchanges everyone knows, Coinbase, Kraken, Binance.
Places where most people buy and sell.
Right. Then various crypto wallets for storing it. Software wallets like MetaMask, hardware wallets like Ledger for more security.
And the mining operations themselves became huge industrial-scale businesses with specialized hardware.
Absolutely. And then there's this whole other layer, the analytics firms.
That's fascinating. What do they do?
Well, because the Bitcoin blockchain is public, they analyze the transaction data. Some, like Chainalysis, work with law enforcement to track illicit funds, follow the money in cybercrime cases.
So much for total anonymity.
Exactly. Others, like Glassnode, provide really sophisticated on-chain data analysis for investors.
On-chain data, like what?
They can classify different types of Bitcoin addresses. Are they long-term holders, short-term traders, huge whales with lots of Bitcoin, or small retail investors? They analyze patterns. Are coins moving onto exchanges to be sold or off exchanges into cold storage? It gives insights you just don't get in traditional markets.
That's really interesting. But despite all this success in the ecosystem, Bitcoin isn't without its critics, is it?
Not at all. Major criticisms persist. The proof of work energy consumption is probably the biggest ongoing one. It's substantial.
And the price volatility makes it feel more like a speculative asset than a stable currency for many.
Definitely risky. And while that early association with illicit activity like Silk Road still lingers in perception.
The analytics firms, like Chainalysis you mentioned, actually show that illicit use is now a very small percentage of total Bitcoin activity.
Yes, their data suggests it's quite small now, proportionally. But the perception issue remains.
What about centralization risks? Didn't you say miners create blocks?
Right. And there's concern because a relatively small number of large mining pools where individual miners combine their hashing power control a significant chunk of the total network hash rate.
So if a few big pools colluded, could they potentially attack the network?
Theoretically, if a single entity controlled over 51% of the hash rate, they could potentially execute certain attacks like double spending or censoring transactions. It's a debated risk, but the concentration is something people watch closely.
And functionally, Bitcoin itself is quite simple, isn't it? compared to something like Ethereum.
Very much so. Its core use case is really just transferring value peer-to-peer and acting as a store of value, kind of like digital gold. It doesn't natively support complex smart contracts or decentralized applications in the way Ethereum does.
And that 10-minute block time makes it pretty slow and expensive for small everyday payments, right? Like buying coffee.
Exactly. The fees and the wait time just don't work well for micropayments, and that limitation is what spurred the development of Layer 2 solutions.
Layer 2, like the Lightning Network.
The Lightning Network is the most well-known example for Bitcoin. It's built on top of Bitcoin, designed to allow for near-instant, very low-cost transactions that eventually settle back onto the main Bitcoin blockchain. It tries to address that scalability issue.
Okay, so looking further out, how does Bitcoin keep itself going economically? You mentioned mining rewards, but they get smaller over time.
Right, that's the halving. It's built into the protocol. Every 210,000 blocks, which is roughly every 4 years, the number of new Bitcoin created per block gets cut in half.
Started at 50 BTC per block.
Then 25, then 12.5, and the last halving took it down to 6.25 BTC per block currently.
And this continues until
roughly the year 2140, when the maximum supply of 21 million Bitcoin will have been issued. It ensures Bitcoin is scarce and has a predictable deflationary issuance schedule.
So as those block rewards keep shrinking towards zero, what's the incentive for miners to keep securing the network?
It has to increasingly shift towards the transaction fees. The idea is that eventually the fees paid by users to get their transactions included in blocks will be enough to sustain the miners and secure the network.
That's a big transition over the long term. Does it worry people?
It's definitely a key part of the long-term security budget discussion. And related to this scarcity, there's this investment model called the stock-to-flow model.
Stock-to-flow?
Yeah. It tries to quantify Bitcoin's scarcity by comparing its existing supply, the stock, to the rate of new supply creation, the flow. It suggests that as the flow decreases with each halving relative to the stock, the price should increase. It's a popular, though debated, model for valuing Bitcoin based on its programmed scarcity.
Interesting. Okay, let's wrap up with some of the philosophy and regulation around Bitcoin. You hear this term, Bitcoin maximalism, sometimes. What's that about?
Bitcoin maximalism is basically the belief that Bitcoin is the only digital asset that's truly needed or valuable. Maximalists often argue that its simplicity, its focus purely on being sound money and a store of value, is its greatest strength. They might see other cryptocurrencies with more features, like smart contracts, as unnecessary or insecure distractions.
Just focus on being digital gold, essentially.
Pretty much. And what's fascinating is that Vitalik Buterin, the creator of Ethereum, which is all about smart contracts and extra functionality, he actually wrote a piece somewhat defending Bitcoin maximalism.
Really? Why would he do that? Seems counterintuitive.
His argument, paraphrased, was that in a world full of complex and potentially dangerous technologies, there's real value in having one system, like Bitcoin, that is incredibly simple, robust, and focused on doing just one thing, secure value transfer and storage, extremely well. He called it a potentially vital security stack.
While acknowledging that his own creation, Ethereum, has become vastly more complex, almost like traditional finance.
Exactly. He saw the value in Bitcoin's deliberate simplicity and resistance to change, even while building something very different himself. It's a nuanced perspective.
Okay, and on the regulatory front, we hear the SEC, the U.S. Securities and Exchange Commission, talking a lot about crypto.
Yeah.
They often say many cryptos are securities.
Right. They use the PoW test, which comes from a 1946 Supreme Court case. It helps determine if something is an investment contract and thus a security. The key elements are an investment of money in a common enterprise with an expectation of profit derived primarily from the efforts of others.
And the SEC argues many crypto projects, especially those launched via initial coin offerings, ICOs, fit this definition.
Yes, because people invested money or other crypto into a project, expecting it to grow in value based on the work of the core development team or company behind it.
But Bitcoin is usually seen differently, isn't it?
Almost universally, yes. Bitcoin is generally considered not a security under the PoW test. The main reason is its origin. It wasn't launched through an ICO where people bought tokens from an issuing entity. It was mined into existence through proof of work by a decentralized network of participants, following the rules laid out by the pseudonymous Satoshi Nakamoto, who then disappeared. There wasn't that common enterprise relying on the efforts of others in the same way.
So if it's not a security, what is it?
The consensus view, especially among regulators like the CFTC, Commodity Futures Trading Commission, is leaning towards classifying Bitcoin as a commodity, like gold or oil. This legal distinction is really important and highlights Bitcoin's unique launch and decentralized nature compared to many later crypto projects.
Okay, so we've covered a lot of ground, from the surprising deep history of digital payments.
Yeah, uncovering those philosophical roots of privacy that really fed into Bitcoin's creation.
Explored how it tackled that Byzantine general's problem with proof of work.
Contrasted that with newer ideas like proof of stake.
We looked at its wild market ride, the whole ecosystem that's grown up around it, the criticisms.
All while recognizing its pretty unique status. Hopefully, this deep dive shows you that Bitcoin is, well, it's more than just digital money.
It really is. It's this profound experiment in decentralized trust, isn't it? And a testament to the power of keeping a design simple and robust.
Absolutely.
So as you, our listener, reflect on all this, here's a final provocative thought to chew on. Given Bitcoin's deliberate design, its simplicity, its immutability, and its likely path towards being regulated as a commodity, not a security, what did that really imply about its long-term role, especially in a world that seems to be moving towards ever more complex, multifunctional digital assets?
Yeah, will that singular focus on just being secure, decentralized money ultimately be its greatest strength, its anchor? Or could that simplicity become a limitation as the rest of the decentralized tech landscape keeps evolving and adding features? Something to think about.